I think let me give a quick background to, and after that, Sameer can take over this session. My first and important observation, I feel this budget is like a Surya Kumar Yadav. I heard somebody that this budget is like a Surya Kumar Yadav catch in the 2020 match, right? And this match has actually taken us back in the game. And you can see that this budget has tried to put in three trinity. First is of fiscal prudence, second is of infrastructure, and third is to generate employment opportunities in the country. These are the three big macro themes I can sense. And again, it is a theme of continuity. This government is there for last 10 years, and we have seen they have been pretty consistent towards bringing more fiscal prudence. I have seen this government is more like a Banya government where they want to make sure the money they are making, they are not overspending. In the COVID times where most of the economies were spending money, I think our government has ensured that we remain fiscally prudent. And that is the big reason that the inflation in our country is one of the lowest in this among our neighbors as well as the emerging economies. So this is no mean task. And again, current account deficit is in control. Fiscal deficit, we are coming back to 4.9% from 5.1%. So most of the numbers looks very exciting, and the government looks, the taxation collection is great. So I can sense that there is a sense of buoyancy while preparing this budget. Whenever the government budget makers were thinking to make this budget, so again I can sense they were thinking with abundance. They were not thinking with scarcity while they were preparing this budget. So yeah, I think these are my quick thoughts, and maybe I will leave the floor open to Sameer now to give his expert comments on budget, and maybe then we will open the floor for question and answers after that. Yeah, thank you. Over to you, Sameer.
Thank you, Tarun, for setting up the context and your perspective on how the investors or the market looks at the budget in terms of where we are going fiscally is very good to know. So we come from the tax side, so we are more looking at the budget from what it does to the taxation for everybody. But on the directional side, the way you said, it actually looks very positive. So what I'll do is I made a short presentation. I'll share the presentation and then take you through some of the important points which we felt were more relevant for the audience here. And then we will maybe open the floor for any questions. I also have my partner taxation Ashwin on the call. So if there is anything that requires his interference, I may call upon to him as well. So I'll just share my presentation now. I hope it's visible.
Yes, we can see it.
Perfect. So first area where the changes have happened is more on the the tax slabs. This is like a formality that they need to do. Intentionally, they want everybody to move towards the new tax regime. We were hoping before the budget that we may even get the news that the government wants to phase away the old tax regime, because we all know that this government is not in favor of a lot of deductions. They want to simplify things. And we also saw that as an intention that, if they're okay to give up a few percentage taxation to get the simplification. But we still have the old and the new regime working for us for now. And there has been a little tinkering in the tax rates, nothing much. The earlier slab till which we had 5% was till 6 lakhs, which has been made to 7 lakhs now. The 10% slab, which was till 9 lakhs, is now till 10 lakhs. And, then everything remains same. So, the basic benefit is only on these two slabs, and above 15 lakhs in this new regime, we are at the 30% tax bracket, while in the old regime, we are still in the 30% tax bracket after the 10% regime. So broadly, in case anybody has a expense on HRA from their salary, or the ATCs and the other things, only then the old regime works. Practically, we have seen that still now at least 80% of my clients, the new regime works better because we would always want to compute taxation in both the regimes and see which one is preferential. And mostly it is for everybody who has a higher tax slab. The new regime is still profitable. There is a small, it's like if they have come, they have to give some small gift. That small gift to salaried employees is by just increasing standard deduction from 50,000 rupees to 75,000 rupees. Not materially going to impact much on the taxation size. Effectively, it gives you a 7,500 rupees tax benefit, 30% if you're on the 30% slab. So that's one thing which it seems like a formality, doesn't change much to the pocket for anybody. One good thing is they have allowed the TCS credit in computing the TDS. So this is for the first time that you have an event happening outside the employer's purview, which gets a credit in the TDS. Generally, till now, the focus has been that the employer would only look at the salary paid by it. And if you have something which is beyond the employer's scope, they would not give you a benefit for, if you have some business losses or something, they would not give you much benefit other than your, housing loan benefit. So here what we have TCSs, which are coming up now. These TCSs are now on foreign remittances. These are TCSs on purchase of cars. So these, TCSs, which are now being collected by, companies through whom we are taking services, were till now being claimed as refund from while filing return. So this was a cash flow dampener for everybody. So that has been rectified. So now if we have some TCS, which is deducted while we do a foreign remittance, buying car or other things, there's going to be more TCS coming in because they're telling that they're going to get more TCS of 1% on purchase of luxury goods. And that definition or the list is still to come out. So that TCS as a regime seems to just grow. But if we have some TCSs coming in, we can give that details to our employer and the employer can deduct lower TDS for salaried class people. So it's a cash flow benefit. This is just a scenario we were looking out, whether if we are in the old regime or the new regime, what is the total tax benefit? So if you are at a 20 lakh salary bracket, your tax on the new proposed regime is 4 lakh 12,000, while in the old is 2 lakh 90,000. So there is a benefit of 1 lakh 27,000 in the new regime. So only calculation that we have to see is whether our other deductions on HRAs and ATC and other areas give you a benefit of more than 1 lakh 27,000 to switch to the new regime. So, that broadly will give us a precursor in terms of how do we decide between the old and the new regime. Biggest area of discussion this time, capital gains. A lot of things changed in capital gains. And so in fact, even right now, while we speak, there are still areas where, we are still grappling to remember them because now there are two things, one is listed, unlisted. Second is short-term, long-term, and then there are tax slabs on that. Good thing is that, where the earlier, 20% slab on long-term capital gain now comes to 12.5% slab for all long-term capital gains. But the bad thing is where everybody who was an equity investor, and I'm sure everybody on this call is because Tarun has been your wealth manager and would always propagate a percentage of your assets to be in equity. The existing tax rate of 10% on long-term has become 12.5%. So this is a dampener. This is something that people wouldn't love because when the history says that when the government came in and brought in STT, they had exempted capital gains and told that rather than collecting capital gains, they are better off collecting STT, which is at source of buying and selling shares. But soon they forgot that the STT had come in to compensate for long-term capital gain tax. And they then started bringing in long-term capital gain tax again. So this time we have seen that both of them have gone up. The long-term capital gain has also gone up by 10% from 10% to 12.5%, and the ST rates have also gone up. So, the government is trying to make money on both sides. They have seen that the markets have gone up considerably and a lot of wealth has been created. So in spite of the tax gone up to whomever I speak, the pinch doesn't seem so high because the returns on their investment are so great. It's my personal experience of speaking to a few people, and some people may be completely not happy about it. but that 2.5% is not mattering much to people. So that's been my experience of speaking.
So,
Arun,
Sameer, I just want to make one point since you are talking about STT. So, STT is only relevant for futures and options. And what has been the big thought process was that the trading as well as speculation which is happening in the market, this government wanted to curb that, and they wanted to bring that breaks through futures and option STT. That was the thought process behind doubling the STT rates. Yeah.
yeah, and I think we may see some more regulations coming in on FNO, because the way SEBI chairperson and the finance ministry have been worried about the growing volumes in FNO. I'm sure this is just a small part. We may find more regulations coming in to curb that. So also to compensate on the rising 2.5% tax, what they have done is they have given again one small token gift, that your long-term capital gain used to be exempt till 1 lakh rupees. Now that 1 lakh has been made 1,25,000 rupees. So you have an additional 25,000 rupees of long-term capital gain, till which you have no tax. Other than that, if you are if you are short-term capital gain, if it's more than 12 months, earlier you used to pay 15% tax. Now that's again gone up to 20% tax. So those are two areas where tax have gone up. Indexation as a benefit has been revoked. We will talk about it a little later when we complete the whole structure of capital gain. This is going to be the one thing which impacts the most for people in the real estate sector. So we'll speak about that in a moment. So this is, we're trying to demystify the whole maze of capital gain. So if you have sold a capital asset, and if no, then there is no problem in life. But if yes, then you look at what is the nature of the capital asset. If it's a listed security, then your period of holding is 12 months, and to make it long term. If it's more than 12 months, then it becomes long term capital gain and hence taxed at 12.5%. If it is less than 12 months, then it is short term capital gain and hence 20% tax rate. So in listed securities, you can be you can be sure that the maximum tax outgo for you is 20% in case of short term, and in case of long term it is 12.5%. Now if you come back and you see it is not listed and it is other securities, then the period of holding goes up from 12 months to 24 months. Now this is again also a welcome change, because they had three categories of period of holding for long term and short term. There was one of 12 months for listed shares, then there are 24 months for unlisted shares, and then there was 36 months for other assets. So to simplify things, they have removed the 36 months as a period of holding for long term capital gain, and all assets now have only a 24-month period of holding to qualify as long term capital asset. So if it is more than 24 months, irrespective of the asset, you have a 12.5% tax rate. If it is less than 24 months, then in those cases, you pay the applicable tax rate, which is your slab rate. So if you hold an asset for less than 24 months, then if there is any gain out of it, you pay your normal slab rate tax. So this is in a gist that what has happened. Now I'll tell you some benefits that have been derived out of this. So what has happened is it has brought on par listed and unlisted shares. So good thing is that people who had unlisted shares, like we had a lot of founders who were exiting their business, they always had a high tax rate. They would have to pay 20% plus surcharge as the tax rate, which now makes it 12.5%. So for the founder ecosystem, as well as for people who invest in private enterprises like a startup investment or investing in unlisted companies, this is a welcome move, because those asset classes were one of the most difficult asset classes to invest in, because the percentage of success was the lower, but when you get a return, the return is among the highest. So it is the classical risk reward ratio. But now that may get a positive flip, because when you exit those companies, where investment technically will be more than 24 months, because the companies take that kind of time to create value, the taxation has come down to 12.5%. So I think that's a big win. That's a big positive. The second benefit out of this structure, what has happened is that they have brought in parity on taxation for non-residents versus residents. So earlier, what used to happen was that we as residents who had unlisted shares would pay 20% tax, but a non-resident on the same shares would pay 10% tax. So a non-resident had a 50% discount on the tax rate than a resident. So this used to create a lot of structures for saving this tax. So in the years in which founders were looking to exit their companies, there would be advisors like us or other advisors who would tell them that if you become a non-resident in this year and then sell your shares, you would get a 50% discount on your tax rate. And I'm sure the government intelligence, the way it is right now, understand all of these. And when a founder of some caliber goes non-resident, it is not just the loss of tax, but it is also loss brain drain for such smart people to go out of the country. So I think that ambiguity is also now out, or it was not an ambiguity, but that differential is also out. So now, even if you're a non-resident or you're a resident, your tax rate remains the same at 12.5%. So I think this is a great move for everybody. 12.5% as a tax rate for unlisted securities for business owners is pretty low, and all those fancy plannings or structures that people would want to create to save taxes, I think would go down a lot, because 12.5% looks it's one of the lowest tax rate that we know in different geographies. So that's more on the capital gain. Now coming to indexation. Indexation is a concept which I'm sure all of us on this call know. Indexation as a concept was to beat inflation. So it meant that there has been an inflation in the country, and our cost of acquisition needs to be adjusted for the inflation. So effectively, if you look at our index from 2001 onwards, which is the new reset, earlier we used to have 1981, our index would go up by around 4 to 5% per annum, which meant that your cost of acquisition, if you purchase something in 2001 for 100 rupees, with all the inflation index that comes in, you may be at a cost of 380 rupees right now, which meant that if you sell something at 500 rupees, you would pay tax on 500 minus 380. This is more predominantly was more being used on the real estate side, that if you had bought a property, the property value would go up with each year of holding, and hence your tax rate would keep coming down if the value of the sale remains constant. So this whole concept of indexation is taken away by this budget. And to compensate for that, the tax rate for even real estate transactions has been reduced from 20% to 12.5%. So you would feel, the finance world is filled with illustrations in terms of, whether the 20% was better with indexation or 12.5% is better with illustration. But on a broader point of view, I may tell you that in case the appreciation is lower for your real estate, the indexation worked well. Because if your appreciation was say 6%, your indexation was 4.5% or 5%. So the differential was too low for the tax rate. But if the appreciation is too fast, like what we have seen in the stock market, then the 12.5% definitely makes more sense. But keeping those calculations aside, I feel that this is a very positive move. This removes a lot of ambiguity about how capital gains are connected. Because in our experience, more than 40-50% of my clients' meetings would only be because they want to sell a property and they want to understand what is going to be the capital gain. Now, even a layman knows what their capital gain is. It's just the differential between your buying price and selling price, and multiply that by 12.5%. So I understand, and even the finance minister had says that in the next 6 months they're going to further simplify the income tax law. So I think this is a positive step.
So, Sameer, I just want to make one point here. Real estate after 2001, I think they made a point, right? Real estate after 2001, no indexation. Before that, indexation will continue.
Yeah, so we are still figuring out. There's an ambiguity in the law. So earlier, what used to happen is before 2001, if you buy a property, your value of your property would be the purchase cost of the property or the fair market value as on 2001. Whichever is higher, you could take that and then have an index on it. Right now, it seems that the intent remains the same, that if a property is purchased before 2001, you take the fair market value as on 2001. And from 2001 to selling price should be flat 12.5%. But I agree with you. The language is a little confusing, and we are looking at some clarifications coming. That is it that if I buy something in 2000, I get an indexation till date, or is it that if I buy something in 2000, I just get the indexation or the fair market value till 2001, and then there is a flat tax. So, but I agree with you. There is some ambiguity there. Right now, it says that indexation is available for properties bought 2000 before 2001. But personally, I was not very convinced that the intention of the law would be that. Hence, I was not bringing this point across.
Sure. Because I think many of us have inherited properties from our parents, right? Which has been purchased in 1980, 1990 also, right? So those 20-year-old, 40-year-old properties, what my understanding was they've been grandfathered till 2001. And
That's right.
after 2001, you will be taken with this non-indexed value.
That's my understanding as well. But the language now says that indexation is available for property purchase before 2001, which means
Okay.
that from 2001 till 2024 also you may have an index, which I don't think is the intention, because that will just create more confusions.
Sure. Okay.
So going next, this is a funny, introduction of buyback taxation. I don't understand the intention for this. I do understand what was happening earlier. So what was happening earlier was dividend was being taxed at the maximum marginal rate, and hence a lot of companies, including large companies like TCS, would rather than distributing dividend would pay buyback, would do buyback of shares. Ultimately, the intention of the companies was to give back the profits to the shareholders. They had two options: either pay dividend or they give buyback, or they buy back their own shares. By giving dividend, it was becoming taxable at the normal rate, while in terms of buyback of shares, the tax was paid by the company, and it was exempt in the hands of the receiver. So what they have done is they have abolished the whole buyback as a concept, that buyback applicability, there is no exemption in the hands of the shareholders. Now what they have done is, the buyback is going to be taxed in the hands of the shareholder. Till here it was perfectly right that we don't agree that buyback should be, the tax should be paid by the company, but it should be paid by the shareholder. But what they have done as a googly right now is that they have said that when in case of a buyback, the tax need to be paid on the sale value. In terms of the entire buyback value is to be paid as, shown as income by the shareholder. So it means that they are not considering the cost of your shares while considering the tax impact. They are saying that the entire buyback amount should be considered as dividend, and the purchase cost that you have will be shown as capital loss. So I fail to understand the logic behind this, but this is what the law is. This has various ambiguities. I'll show you how it looks in an example. So if we had 100 shares, and we had bought it at 40 rupees, and there is a 20 shares which got bought back at 60 rupees. Technically, I made just 20 rupees on the buyback, but the budget now says that dividend in my hands is the entire sale consideration, which is 60 rupees into 20 rupees. So the entire 1200 rupees will be taxed to me in form of dividend, and the cost price of those shares, which is 40 rupees into 20 rupees, that is 800 rupees, will become my capital loss. Now, if I don't go further, and if this is the only transaction that I had in my books, then it means that I will be paying tax on 1200 rupees, and my 800 rupees of capital loss will get carried forward, because capital loss per se is not allowed as set off against other sources of income. So, this could lead to a, way where I am paying tax on the entire sales and my capital loss is getting carried forward. But in my example, what I have done is we have shown that the other 50 shares have also been sold at 70 rupees. So I make a capital gain of 1500 there. And out of 1500, the earlier loss of 800, I'm knocking off, which is the cost of acquisition of my bought back shares. And then I pay capital gain tax on 700 rupees. So this is against the principle of simplification. This is a complication that's been created. While the intent was right, but I think the method used to get into the intent doesn't seem completely right in this matter. So this is some, for people who are in business, maybe there are TDS rates which have changed. Not very relevant to all of you all, but there are some brokerage commission which was at 5%, which has gone back to 2%. And these are good for cash flow, right? Because the receiver of the services, the giver of the services also always had a big amount which was blocked in their TDS, and they would always have to apply for lower tax deduction certificates from the income tax authorities. One new thing that they have gotten, which was not there and which was not even anticipated, was TDS on remuneration to partners. So till now, remuneration to partners, the rule said that 60% of your profit is allowed as remuneration. There is a minimum slab and then 60%. And that remuneration is allowed, is taxable in the hands of the partner and is available as deduction in the hands of the firm. But there was no concept of TDS. But right now, if you have a withdrawal every month of remuneration from your firm, you have to ensure that you are paying 10% TDS on the same as well. And there is one more clarification which has come in on TDS on property purchase. So when you purchase property above 50 lakh rupees, there is a TDS that needs to be paid by the purchaser. Before this, there were interpretations, and we would also go by that interpretation was this is 50 lakh per person. So if you had 3 joint owners in a property who were purchasing a property, till 1 crore 50 lakh rupees, this TDS wouldn't apply, because it was interpreted that this is 50 lakh rupees per person buying the property. So joint owners together, if 3 of them are buying. But right now there is a clarification which has come in, which says that when you want to see the limit of 50 lakh rupees, it is not the buyer, but it is per property. So it's qua the property rather than the buyer. So right now, if 3 people come together and buy a 60 lakh property, the TDS is still applicable. Abolition of angel tax. This has been the most talked about subject for the last few years, and the logic didn't ever seem right, but there were some loopholes that the government was trying to plug. We know the background because there was a lot of money being routed into companies as premium, but the actual ecosystem of startup ecosystem was getting disturbed because we had so many litigations going up where the income tax authority would say that the premium charged by the company is an income to the company. So the angel tax per se as a law meant that if you are raising capital by way of premium, so the premium charged above fair market value is taxable as income for the company. And what is that fair market value was always questionable. So startups, you would find that they are zero profits, but still they had valuation. Some startups had nil revenue, but still they had valuation. And it was very difficult for the income tax officers to understand, or for the consultants to explain to them that there was a value and the value was justified. And this has led to a lot of litigations, and there are still some litigations going on. So while the government wants to be pro investments, they want foreign capital and more capital to be pumped into startups and helping SMEs raise money with capital. I think this is the best step that they have taken in the right direction, that there are going to be no angel tax. So if you raise capital by way of premium, there are going to be no angel tax to the company. So, and also the finance minister had clarified that it is not the intention of the government that on one hand they would abolish the angel tax, and on the other hand they would keep fighting those litigations. So it's from that statement, it seems that the old litigations should also go out easily. So no change in corporate tax rate. We would have been more optimistic if we wanted a tax rate below 25%. If that could have come in, it would have been great, but we are not expecting that. Taxation on foreign companies have reduced, and no changes in cess and that. Other 2 points. This is the last slide. The government has again come out with a Vivad Se Vishwas scheme, which is an amnesty scheme, which means that if you have litigation, government doesn't want to spend their time resources into litigation. So if you are into appeal, you have an option to pay tax, and there is an option to waive off your interest and penalty. The scheme details have just come. We are just going through them for more details. And disclosure of foreign assets. So while disclosure of foreign assets, government has said that if you have foreign assets, which we found that a lot of our clients had, specifically for clients who had moved from outside India back to India, and they never thought that it was important for them to disclose foreign assets into India. The finance ministry has certainly said that till 20 lakh rupees of foreign assets, we will not levy a penalty, which the tone is on the other side, that if you have more than 20 lakh rupees, you could have penal provisions if you don't disclose them in India. So I think here there is a lot of ignorance, and there is a lot of reason why people don't want, there is a mental blocks why people don't want to disclose foreign assets in India. but the statement of the finance minister shows that they are very serious about it. So we have to be more careful when we have any assets in foreign countries to disclose them in our tax returns. So these are things which were broadly important, and I thought for this audience, let me discuss all of these. And if you have questions on this or anything around it, I'll be happy to answer.
Thank you. Thank you very much, Sameer. What I will try to do is, Sameer did mention a lot of nitty-gritties around the budget. I will try to specifically take some part.
Comprehensive financial plan as a slide.
I am sorry. I think my... Can you see it now?
Yeah. Now we can see it.
Sorry. Yeah. So what essentially I wanted to bring to attention is capital gains have been rationalized to another level. And I think globally also, most of the countries, nobody had this indexation concept. It is an Indian jugaad. I would say the indexation has been brought in India. It's an Indian jugaad by most of the finance ministers who have worked before. Now they are trying to rationalize it. Holding period is now only either 12 months or 24 months. Unlisted bond, debenture, debt mutual fund, and fixed deposits, they will be taxed at slab rates. Again, more than 12 months considered as long term will be all the listed equity mutual fund, listed bonds. Again, this is a very welcome move. REITs and InvITs have been brought in under 12 months. So according to me, this is a very positive move for a lot of retail investors who are looking at bringing exposure to real estate. Since the size of transaction of real estate goes in, let's say 50 lakh crore in crores, REITs become a very, very popular instrument. Globally also, REITs and InvITs are very popular instruments. Now, any investor with as low as 5,000 rupees can also participate in REITs, and it gives you exposure into real estate, which is a very positive move. Again, assets which have been more than 24 months considered as long term is unlisted equity shares. Sameer did mention that in detail. And I feel this is going to bring, I think that energy in startup entrepreneurs, because unlisted equity selling, according to me, earlier there were no clear rules available. Now it has been made very clear, 12.5%. So I think it's a very positive move. Property, according to me, the property investments, if I look at 100 rupees invested, in India, still 5-7 rupees is in capital markets. Most of the money is in fixed deposit, and after that, money is in gold, and the fourth part is real estate. If I look at real estate, I've tried doing one small case study here, that let's say sale value of your property is 2 crore, and in so your cost 10-year back was, let's say, 1 crore. Your index cost used to be 1.5 crore. So from all this, there is a 3 lakh rupees additional tax which you will have to pay under the new regime, which I think is taking off the indexation part. Sameer, you think this calculation are correct?
Yeah, this should be correct. So only only area is that where the appreciation is lower, you will gain from the index old method. But if the appreciation is high, the 12.5% will be beneficial.
Correct. So you have to see case to case basis how it will work. But yeah,
in your example, the appreciation is around 7%.
Right.
So it's doubling in 10 years.
Right.
So, and your index is generally around 4.5. Indexation is 4.5-5%. So hence the tax liability in that case looks lower.
Correct. Sure. But all in all, I think looks like it will bring in more tax liability for investors from the real estate 12.5% move. Okay. One more welcome move which I see is a clarification, which was again a problem which was created in the last budget. was a category which I wanted to bring to everyone's attention. If you can see in equity, I will take a mutual fund example. So let's say equity mutual fund, which is like more than 65% equity, the long-term capital gains are 12.5%. Again, specified mutual fund, debt mutual fund, there are again case studies which we need to specifically understand. But anything which you have acquired after 1st April 2023, that will be considered under slab rate. Okay. Again, sold up to 22nd July, the budget date, they have made a special provision. The old 20% indexation will continue. Again, sold on or after 23rd July 24, there is a 12.5% indexation benefit which they have brought in. But just as we talk, if you buy any debt mutual fund today, you will be taxed at a slab rate, whatever is your slab rate now. Again, there is a category called 35 to 65% Indian equity, which according to me got a very good clarification in this budget. So all these fund of fund, all these gold funds, all these foreign funds, all of these were falling under this category, which is being clarified now that we will get 12.5% long-term capital gain there, which I feel is a very big boost in terms of building more asset allocation products for the investor. Again, in the current environment where we have seen equity markets have gone up so significantly, I feel asset allocation strategies looks much more favorable to me right now. So this is a welcome move according to me in the current environment. Yeah. Again, yeah, I think this was, if anyone has any specific question on capital gains, please do write on the chat box. We can take that specifically. Yeah. I think TCS point, Sameer, you already clarified. Again, NPS is also one very positive move which I saw in the budget document. So instead of 10% of the salary, now 14% of the salary under the new regime, if you invest under NPS, that will give you tax exemption, which is a very, very positive move according to me. And just like US 401k, government want people to invest into retirement assets, and these retirement assets are market driven. Again, NPS has been, I can see a lot of innovation which has been made in NPS currently. You have products available at 50-50 equity, you have products available at 70% equity, which gives you participation in the market. Again, they are the lowest cost products available in the market. So let's say, even if let's say 12% growth, if you can get on the NPS product, and the immediate tax benefit what you get, say 10% of your salary or 14% of your salary, I have done that reverse calculation, and I feel it's a no-brainer product in the current environment to look at NPS. Yeah. So maybe Sameer, you want to throw any light on this NPS thing?
Yeah, I think it's a great instrument to save taxation. In the new regime, the intention is not to give any deductions, but this is the only one of the exceptions that they have given. So even in the new regime, 14% of your investment can be used. You can get a deduction. So it's benefit both ways. You have a great investment product, and you have a great tax saver as well.
Sure. So I think Kunal has a question, Sameer. So tax deduction for NPS was 50,000. What will be the deduction now? You
So
want to
these
take
are two different sections, Kunal. 50,000 is for people on their own contribution. So if from your contribution, you can contribute 50,000 rupees, which still remains. This is not related to somebody being a salaried employer. This 14% rule has come in where employer is contributing 14% of the basic and DA as NPS, and that is allowed as a deduction, both to the employer as well as a tax benefit to the employee. Your 50,000 still remains 50,000. For this is irrespective to these are two different sections.
So, thanks. So Sameer, maybe I think my request would be, if anyone wants to ask any question, please feel free to ask here. So we have Sameer here. He can give you quick answers on your queries. Anything else, Sameer, which you feel are the highlight of this budget? Anything interesting which you felt from a professional point of view and business owner point of view? Any other benefits which you saw in this budget?
Reopening of assessment is something, that's always the the tool which is being used by the income tax department to go back and ask details and questions for years, where it's very difficult to organize documents and organize reasons for some transactions that have happened. And this was being rampantly used right now. So the earlier, there was a uh, the intention the government showed earlier was also that they don't want to go back and reopen, and so they had given a window that only in extreme cases we will go back to 10 years. And they had some rules there, but we saw that those rules were being misused by the department, and people were being sent notices for 10 years of reopening of assessment. So they could go back as 10 years to open assessments. But now I think that intention now has come in more handy in terms of clarity in the law as well, where they have restricted it to 5 years. So there is 3 years where your income escapement is less than 50 lakh rupees, and if the escapement that they feel is more than 50 lakh rupees, they can go as far as 5 years. So that ambiguity from 5 to 10 years is also gone. So I think that's also a very positive move by the government, where the intention is now getting reflected in law.
Interesting. Sameer, we have one question from Mr. Shailendra. As most employee have EPF 12.5% employer contribution, and if you invest 14% in NPS, it is also treated as employer contribution. Above 7 lakh, employer contribution is being taxed, so may not be beneficial for all. Do you agree with that?
Above 7 lakh, I didn't get that. How 7 lakh came in?
So there is a limit of 7 lakh of employer contribution in NPS. So it gets taxed. So the tax-free status goes away.
Okay. I'm not aware of that 7 lakh. So 12.5% employer contribution uh, uh, is your PF deduction that you get. So in PF, the rule says that the employer puts in 12.5%, the employer get that as a deduction. The employee share that goes in around 12.5% is available as ATC in case you are in the old regime. NPS is 14% of the investment of the employer, which is available as a deduction.
Right. Sameer, what has happened last budget, government has brought in this rule of 7 lakh. More than 7 lakh into EPF, it will be taxed. So that was brought in last year. So under that, I think Shailendra question was that 7 lakh and more employer contribution. So with this 14%, will that be
No, no,
enough?
no. These are different section. NPS is different and EPF is different. So 7 lakhs was only for PF.
Okay, okay. So you mean NPS will have, let's say someone's salary is 2 crore rupees, and let's say he makes 12 lakh rupees per month. So on 10% of 12 lakh mean 1.2 lakh. So maybe around 12-15 lakh rupees he can invest into NPS.
So earlier they had capped the limit at 1.5 lakh rupees of deduction. Right now, we have still to go through the fine print, but we didn't see a limit there. When this 10% became 14%, earlier the 14% limit was already available to central government and state government employees, and to private sector employees it was 10%. What they did this time was make the parity between central state government employees and the private sector employees, where they moved it from 10% to 14% for both. But the cap on exemption earlier available was 1.5 lakhs. So I will just have to get into detail whether that cap remains the same or they have changed. Like you had that 7 lakh rupees on PF, like he rightly said, it will become tax.
Sure. Shailendra, we will come back to you offline on this query. Thank you for bringing this to our attention. Kunal, your question on debt fund taxation. Again, I will just take this illustration here to just clarify this part. So what essentially I think we've been trying in this part is one second. Yeah. So if you have a debt mutual fund, anything which you buy today, you will have to pay marginal tax rate. There is no indexation available. There is no 12.5% available. Okay. If you have purchased any debt mutual fund, before 1st April 2023, if you have sold it before, let's say 22nd July 2024, there will be a 20% indexation on that. So the old rule continues in that. But if you sell anything which you have purchased on 1st April, before 1st April 2023, and you are selling it after 23rd July 2024, the long-term capital gain of 12.5% will be applicable for you. And here the definition of holding period will be 24 months. But just make a note that it is only for cases before 1st April 2023. Anything which you are purchasing after 1st April 2023, you will be taxed at the slab rate. That is one very important part to make a note. Sameer, you want to clarify anything on this?
So what they are doing is they are bringing parity on taxation on a fixed deposit and a debt mutual fund. So
Right.
your interest on fixed deposit used to be taxed at the maximum marginal rate. They are doing the same for debt mutual fund. There was a tax benefit that was available on debt mutual fund versus fixed deposit. So that arbitrage is gone now.
Correct. I think one more question Sunil is asking, and maybe Sameer, you can take this question. Would it be fair to assume that government prefer businesses to adopt corporate structure? Are you seeing this trend?
Nothing that in this budget, we saw that as a trend, but definitely there. So there is a gap on taxation between LLP partnership structure, proprietary structure versus a corporate structure. Our expectation this time was that if the government could bring parity on that tax rate, because a LLP structure gets taxed at 33%, partnership gets taxed at 33%, a proprietor gets taxed at an even higher slab if their income is about 2 crore. And the corporate structure is taxed at 25.17, which is the maximum tax rate. So there is a 8% differential in the tax rate between corporate form to other forms, which we expected that maybe this time they would want to either lower that gap or bring parity around it, but we didn't see that. That is the only reason why we feel that corporate structure is being preferred. Otherwise, nothing specific in the budget was only for corporate structure. But then you again, if in the whole picture, if you look at while the corporate is being taxed at 25.17%, a dividend from the corporate structure in the hands of shareholder again gets taxed at the maximum marginal rate. So effectively, if the money has to move out of your corporate form, then in fact the LLP looks better. So it's case to case, but if the money is going to be reinvested in business, a corporate tax structure still makes better sense. Would you see a parity in tax structure happening? I don't see that coming very because the LLP and partnership form has the single point of taxation as the benefit. So you pay tax in a LLP and a partnership form, and the money moves out of share of profit in the hand of partner without paying any tax. So that is that benefit which a LLP and a partnership structure holds, which is not available to a corporate structure. Corporate structure is beneficial only when the profits have to be reinvested. So I don't see that happening very early. If they try to bring in that parity, I will not be surprised if they start taxing the partners' share of profit against in their hands. We saw that happening in buyback of shares this time. So personally, I don't see that coming in near future. They may just try to reduce the bridge of 8% to maybe 6%, but not bring in the same tax rate.
So, Sameer, I will not lose this opportunity because you are an expert helping a lot of business owners scale up. And what have been, maybe I think we can speak a little bit on the founders part. What has been the challenges you have observed while dealing with a lot of business owners, while building up cash flows, while building up good accounting policies? Maybe you want to touch upon anything which you feel time has come where everybody should get more organized, more systematic. Any specific challenges you have observed? I think use this opportunity and this platform to share that, please.
Sure. Thanks, Tarun, for bringing that up. So I've been practicing for 26 years now, and I have seen change in the way the business environment has happened in the last 26 years. In the first 5 to 10 years of my practice, the thought process of every business and every consultant was that everything is okay. In Hindi, they say sab chalta hai. You do some things which are not very compliant on the taxation side, and everything can be managed or it will never be seen. Either the income tax authorities will or the tax authorities will never see it, or even if they see it, everything will get solved. But now the way the transition has happened, with everything getting digitized, your scrutinies and your inquiries are no longer dependent on a person. It is dependent on a machine which is doing data analytics, which is gathering your financial data from various sources and mapping it to your returns that are being filed. So data analytics and computers are trying to find problems. Second, now the assessments and are being handled in a faceless manner. So you don't know, you see a, while it's a human on the other side, there's a computer there whom you're replying. So things will happen the way it has to happen. So right now, and with the penal clauses going up a lot, government, while they're trying to decriminalize a lot of those things were still very high in the TDS provisions, where there were prosecutions for a lot of TDS provisions. So being compliant in this business environment is most important. I think government is doing its bit to reduce taxation, make law simplify, but I think no shortcuts and no ignorance of law will work now. So by ignorance of law never worked in law. You cannot ever say that I didn't know about this law, so I should not be penalized for it. So being 100% compliant is the first thing. Second thing, I saw as a major challenge for founders was that while they were doing business and they have been doing it for a long period of time, they are being driven more in their business by passion and gut feel, and they have not been able to get their hands on the nitty-gritties on the numbers. So some kind of a financial education or spending a few hours in a month on looking at your numbers with financial lens in a dispassionate manner sometimes go a long way for founders to take the right decisions. So decisions on your revenue growth, your gross margins, your fixed cost, and the biggest question, where is the money in my business? Because a lot of founders have those questions that I am doing well but I don't see money in my bank account. So if you are able to put some couple of hours and look at your businesses through financial lenses, the kind of insights that can be generated there will go a long way in helping businesses grow. So I think, on the top of my mind, these are two things that every founder, if they do right in being 100% compliant and getting some financial discipline and governance in their business, go a long way in building a great, valuable company.
Right. So, Sameer, another category where a lot of people, I know many have joined today because of the time. Many will see the recording part of it, and many of our clients are busy professionals where time is the biggest challenging thing, and they engage with us to bring time in their life as well as bring more structure in their life. For working with highly paid executives, any areas which you have observed needs attention, and any of your quick thoughts on that?
So I think what you're doing is the great thing that every busy professional needs to work on. I've seen my friends who are chartered accountants and who had treasury for banks having lakhs and crores of rupees in their saving bank account. So while they are doing great work at what they are doing, but that is consuming that so much that it becomes difficult for them to build their own discipline around wealth management and documentation. So I think one thing that they should definitely do is work with somebody who is helping their money make more money for them, and also organize their documents in a manner which makes it very easy for them managing money and managing other areas of their life, like right from having a right will, succession planning, to having the legal, the property documents in the right place, and having the investments well worked out as per asset allocation that you were rightly saying. I think that is one thing that everybody should be doing, because that's one pain point I have seen with a lot of busy professionals. They are so good at what they are working on that they don't have time to work on their own finances.
Interesting. Thank you. Thank you, Sameer. And I just want to give a quick, many of our clients have been asking that with this budget, because last 1 month we have seen two, three very big events happening in the market. One is election result on 4th June, and second, this budget. And markets have been keenly watching that these two events will have what kind of impact it will have on the markets. But surprisingly, markets, though on 4th June we have seen the reaction, but again it has came back into shape again. Currently also we are not seeing any stress on the market, even with the capital gains proposal. My strong understanding is nobody can predict the markets, and trust me, I don't know anything on the market. When I people ask me क्या होने वाला है market का, तो मैं हमेशा यही बोलता हूँ, I don't know who will sneeze at US and what will happen in the market here, right? So getting into that will actually doesn't help anyone. So we should do things which we can control. Asset allocation is something what everybody should practice. If you have money which is available for 5 years, 7 years, it makes great sense to participate in a growth asset like equity, which is going to compound. And in a country like India, where the nominal growth rate is in double digits, it makes great sense to participate in the equity. But above all, I think the rules of asset allocation, safety, stability, aspiration, that need to be always be considered before looking at any investment avenue. So these are my final words, and thank you very much, Sameer, for your insightful for this insightful session. And thank you everyone for your active participation and insightful contribution during today's budget session. Again, I feel these were really valuable, and I appreciate the time and effort each one of us has put in understanding and analyzing the budget implication. Together, we have laid out the groundwork for informed decision making and strategic planning. I look forward for our continued collaboration and positive outcome we can achieve. Thank you very much, and have a great day ahead. Thank you very much.
Thank you. Thanks.